Here? Sorry, I wasn't using my mic. Here.
Fran McGregor,
Present.
Jeffrey Kirst,
Present.
Mary Lamont,
Present.
Okay, so we have a quorum. We will move to section 2 of the agenda. I believe that we will take public comment on each action item here today and then at the end of the agenda. So we will move to agenda item 2.01, approval of the minutes of February 22nd. I hope you all got a chance to go over that. Any changes or corrections that anyone would like to make?
Jeff Kirst, I had one question about the minutes on 2.02. At the end, it says cash balance down and are constantly being replenished by employee participation, or is that employer participation that puts the money back in?
You are correct, Mr. Curse. As always, it is employer contributions. Yeah. Yep, thank you.
Thank you.
So we'll make that correction to change that one letter from an E to an R. And with that, do I have a motion to approve the minutes of 2:22? Oh, yeah, go ahead. Sorry. Yes.
Fran McGregor. I move we approve the minutes of the last meeting as changed.
Okay. Do I have a second?
Jeff Kirst, I second the motion.
Very good. Any public comment? Seeing none, all those in favor say aye.
Aye.
Nays, say nay. Seeing none, motion passes unanimously. So now we move on to agenda item 2.02. Because we moved this meeting up from May to April, we actually do not have the statements from Nevada PERS, the RBIF statements, in order to compile the unaudited third quarter financial statements. So that's why you don't see anything in your packet. So just explaining that. We'll next turn to agenda item 2.03, and you can see there, hopefully, the one-page summary of investment performance for the Retirement Benefits Investment Fund, RBIF, as of 12/31. Again, this is what we have available at this point in time. You can see that fiscal year to date, which would be July 1 through December 31, the fund saw a return, an annualized return of 6%. Over the last year, a return of 18.3%. So you can see the breakout by asset class there. This is for discussion only. Any questions? Okay, seeing none, we are now on to the meat of the agenda. This is agenda item 2.04. We'll flash up the PowerPoint on the screen, and then you also have the hard copy presentation for this item. This is for possible action. And so just to tee it up, and let me ask Mr. Matt Bowden of Buckhead Capital Management to come to the desk. But just to tee up this item, we've talked last two meetings about an investment strategy for the OPEB trust fund. In short, we've talked about moving out of the RBIF blended portfolio, which is tilted towards stocks, to de-risk the portfolio and to move to fixed income investments, essentially to take our chips off the table. We had prepared information before that showed what our kind of hard liabilities are, what our cash outflows out of the fund will be over time. And, you know, when we were looking at it, very close to the total assets in the fund. So in terms of comparing total assets to the hard cash outflows we would make, we were thinking we were nearly completely funded. And as this presentation kind of goes into, we're actually overfunded in terms of kind of what we can do with investments. But at the last meeting, we talked about possibly having an outside asset manager who does this for a living, give a presentation on this topic. Buckhead Capital Management is the district's asset manager for our operating and capital monies. We always have more than 500 million in the portfolio. Usually it's more than 600 million, kind of fluctuates, obviously. So Buckhead Capital's been managing our monies since 2018. So they're our current provider for the district, not for OPEB, but for Washoe County School District. As Matt Bowden will go into, they have a lot of experience in the state of Nevada for other entities as well. But based on the action the OPEB committee took last time, we invited Matt to come here to give this presentation. We provided Matt with the actuarial information that you all saw and asked basically Buckhead, what can we do? Can you construct kind of a model portfolio that meets our needs? What would that look like? What are the pros? What are the cons? So with that, I'll turn it over to Mr. Bowden to go through this presentation. And Matt, is this kind of interactive along the way? If we have questions, can we go ahead and interject those questions?
Absolutely. Please, at any time, if you have any question, please feel free to stop me. And Mark, we didn't really talk about this ahead of time, but in terms of time frame,
We have till 5 o'clock, but please don't take all
fair enough.
all 80
I can get a
minutes
little
of
long-winded,
that.
but I won't.
Yeah. But
Fair
time, it shouldn't be an issue for
Fair enough. Okay, perfect.
I second that.
Yeah.
Excellent, me too. Yeah, if we could go, just kind of get into it, just to kind of give you a little bit of a background on us, and can you hear me okay? As Mark mentioned, we've been working with the county since 2018. We are one of two current investment managers that are the outside managers for the state treasurer's office. So I've actually known Mark, since he moved to Nevada back when he was in the capacity at the state treasurer's office, working with them. I have been working out here in Nevada just this month. It's now been 20 years. I've been working with local government entities, out here in the state, working at the state level, working with school districts, and also with cities, counties, and hospitals, throughout the state. So a tremendous amount of experience that we bring to working with public governmental entities in Nevada. And I'll tell you what, one of the things that we've really seen a lot of here with the changing interest rates that we've been in a 15-year period where we've been effectively in a zero interest rate environment. And now we're at a point where we have 5% type of interest rates again, and we have real income that we can generate. And so it's really changed the conversations that we're having around these types of portfolios, because the position is now different, and we'll get into it in a couple of different slides later about just the ability to that you have here, because as Mark said, you guys have all done a tremendous job managing this portfolio to get it to this point where you're in a situation where you're really effectively overfunded, and where you can lock in and immunize is the term that we use for it, which I'll get into a little bit more here in a second, but kind of immunize that those payments that you have to make in the future without the risk that you currently have. And we're in this position now because interest rates have gone up, they're subject to going back down, right? And then all of a sudden we can't have this conversation again, right? Or the same thing with the reason that you're in the overfunded position that you're in is because the portfolio that you're in right now is so heavily invested in equities too. And that's always subject to change as well. We could certainly see, clearly the stock market has been very one directional, but that is also subject to change as well at, pretty much a moment's notice. If we can go one more, just briefly again, just to hit on this, there's me pre-beard, or kind of in the middle of beard COVID season. But the team, myself and Rick Nelson and Chad Stevens, the three of us have been working together now for over 20 years. So as a team, the three of us have a tremendous amount of experience, again, just working out here and doing this. And we're just telling this all just to give you that comfort level of, the depth of experience that we have doing this with public government entities in Nevada. And on the next slide, this is again just talking about our process. and a little bit about us, just to give you a little bit more of a background. But we take a very kind of holistic approach to a fixed income portfolio in terms of looking at all the different components that can go into it. How much interest rate exposure do we want to have, which is really the primary thing that we're here to talk about today, is going out, because now that when we were in a 0% interest rate environment, we were staying very, very short term on our investments, on our fixed income investments, because we didn't want to lock in 0% interest rates for a very long time. So our duration is the measure that we use to say how long are we investing for. It was very, very short. We were keeping everything very defensive because there was at 0% interest rates, there was the risk that rates were going to go up, and we wanted to have the ability to reinvest those. And if you had 30-year or 10-year Treasury bonds in a 0% interest rate environment, they're worth cents on the dollar now of what they were worth because of how much interest rates have gone up. But it's the duration now, as interest, we've gotten to a point where we're talking about, as I said earlier, real income in the portfolio, and it's one of the things on the general portfolio side that Mark and I talk about quite a bit is this is real interest earnings for the school district. So let's go ahead and lock this in for as long as we can and take some of that volatility risk off of the table. So it's the same, even though it's a different context with the school district's general funds, it's the same type of conversations that we're about to have here that we've been having with all of our clients, and it's really a function of just how much interest rates have changed and how much the market has changed compared to where we've been over the last several years. And the next one is just one last slide on us, just kind of again just to give you all a sense of comfort of the solid work that we have done for the school district, and the reason that Mark has brought us here today is because we have a long history again of producing excellent performance. We get assigned a performance benchmark when we sit down at the inception of a relationship and say, hey, this is our target that we want to invest in. We want to get this for our investment program over the longer term. That's going to be our kind of our target, and then we try to add value above and below that through our investment process, all the different things that were on the previous page that we do to add value. And you can see over all the time periods, we've done above and beyond, added a lot of incremental return for the school district. And so you look at these numbers here, and gosh, it's amazing how quickly my eyes are starting to go. But when you look at the 3-year number, at a 162 versus 69 basis points for the index, when you talk about putting that in terms of real dollars for the school district, as Mark mentioned, we have $500 million in this portfolio. If we're adding an extra 1% on that every year, that turns into millions of dollars in real tangible money for the school district. So a lot of value that we've been providing, we feel, for the school district over time. So that's enough about us. Let's talk a little bit more about what we're here to talk about today. And so starting on slide 6, I use that term portfolio immunization. And basically, when we talk about immunization in the financial perspective, what we mean is that we have some known cash flow obligation that we have in the future that we have to pay for. And in this case, it's the other post-employment benefits, right? But we have a fairly well-defined number from our actuaries that tell us what our schedule is going to look, what our liability schedule is going to look like. And if we have enough money saved to cover those obligations, then the goal should be to do that with as little risk as possible. Because, and we use the example of if you're saving for college, and my son's a senior in high school, so I'm very familiar with this. But if you're saving for college, once you get to that point where you think that you have enough money to pay for their college tuition, you're not going to continue to pump money into that every month, and then you're going to have less in terms of risky assets and go towards more safe assets. Keep it in cash. You can, if you literally have enough money, take it out and stick it under the mattress at night. And then you don't have the risk of the market risk or the market volatility, because again, the market conditions are always kind of subject to change. So and this is the one kind of complicated part of this discussion, but when we talk about how we do this, right, there are securities that are called strips. They're treasury strips, and what they do is they take a treasury security, so bonds that are issued by the United States government. Oh, sorry, one more page. No problem. Sorry about that. So they're securities that are sold by the U.S. government, but then they're taken, instead of having a bond, generally, Treasury securities, they have a final maturity, and every year they pay you coupon payments, interest payments twice a year. So if you buy a 5-year bond, you're effectively going to get 11 different cash flows out of that from a Treasury. You're going to get 10 coupon payments, 2 a year for 5 years, and then at the end, you're going to get your maturity back. So you'll have 11 different payments. They will come on different times, and you'll know when all those are. So these strip securities take out that when you have interest payments along the way, you have what's called reinvestment risk. So when I get my coupon payment, am I going to reinvest that back into the 5% that I'm getting today? Or if interest rates go down, am I going to reinvest that back into, what's now potentially a 0% interest rate environment? So we're not going to earn as much as we thought we were going to yield along the way. But by buying a security that has only one cash flow that we can match up to all of our liabilities, the actuarial stream that we look at, we can buy cash flows, bonds that mature in and around when we're going to need those money for the amount that we are going to need to buy, to cover our cash flows. And we can buy them at a discount today, and we'll get to the math in a second in terms of what that looks like. But if we go one more in terms of, again, this is talking about why this is an opportunity that is available to us now. And it's because it's the market conditions that we're in. Because interest rates have gone from very low to very high, and because of the performance of your overall portfolio, your portfolio positioning, you've gotten to a point where you are very, very highly funded. So you are now in the top right corner up there in that green box. We're at a level where interest rates are higher, and the level of our funding, the level of our portfolio funding is high enough to do this. A couple of years ago, we may have been in a position where we were more in that red box. We were definitely in a low interest rate environment. And when you're in a low interest rate environment, as I mentioned earlier, you can't really do this because you don't have the interest earnings to do it. It's only because we have the interest income that is potentially out there in the market right now that allows us to do this. And as the funding's gotten better and the market position has gotten better, we've moved to a position again where we're now kind of in that top right corner in that green box. And I'm going to go, let's skip that one, Don. Let's just go to 10. Because 9 and 10 kind of tell the same story. But this is the idea of your funding position for now, right? The portfolio is in the position is, again, in large part because we've had a tremendous run in financial equity markets and stock markets, right? Which is subject to change. And if we get a drawdown, all of a sudden we may not be able to have this conversation if the S&P goes down, 15, 20%. Then all of a sudden we're gonna move from that green box, back over to the underfunded box if we get a stock market correction. And so that's the risk. Again, when my son was born, right, I was taking all of my investments every month. I'd put the money in there, and I was investing it primarily in stocks because I had 18 years until he had to go to college, and I had no money there yet to pay for it, right? So I wanted the highest return I possibly could. Now we're a year away from him going. I pretty much know what it's going to cost me to send him to college, right? I have enough money there to do it. So instead of continuing to pump more money into it and continuing to keep it in risky stocks, hoping that they go up and hoping that they don't go down, I'm going to take it, I'm taking and basically putting it in cash at this point and just letting it sit there because I have all the money saved that I need. So I don't feel the need to take the risk anymore. And so that's what we're really, looking at here is that, the stock market right now, it has been very much like this for 2 years, and there's certainly the risk that we could see things turn. And, what the problem with your portfolio becomes is that you end up losing on both sides in those situations, because if we get into a crisis situation and stock markets start coming down, well, the Fed's also going to start cutting interest rates, and interest rates are going to start coming down too. And so then you're losing on both sides. You're losing on the funding side, and you're losing on the interest rate side. So, the idea is now while we're in a position we could potentially, lock this all up if you so choose. So, go ahead, Mark.
So can I stop you there?
Yeah, absolutely.
So, I guess the thesis here that we're really talking about is you know, we're kind of in this sweet spot. We were invested in equities since the district's really put away or created an OPEB trust, and we've seen a tremendous, you know, run, a tremendous bull market. And now we sit where we're, you know, depending on how you calculate with, let's just say a funded ratio of 100%. Assets equal liabilities, basically. And at the same time now, we've seen this yield increase to fixed income. As Matt was saying, when interest rates were 0, 1%, whatever, you know, you'd need a lot of money to lock in those liabilities in the future. At 5%, it's a world of difference from 1%. So the planets have kind of aligned, if you will, where we reach this point where our funded ratio is 100%. We can de-risk, invest in fixed income because fixed income yields are finally at a place where you're paid to invest longer. So, you know, we've been talking about this a while. It probably won't change next week, but at some point it will change. That, you know, where we're at will change. So this is why we're bringing this conversation to the committee to say, okay, the planets are aligning. We have the ability to do this. Do we want to do this? Do we want to de-risk? I know, spoiler alert, but we've talked about it before, right? So I just want to emphasize this is kind of a unique opportunity and timing for this portfolio. Other times in the last 5 years, it wouldn't have been possible. But it is today, so that's why we're asking this question.
So if we go one more forward, and this is kind of the conclusion of putting all this, you know, it's a lot more easy to see numbers on a page than it is for me to try and explain it, to be honest. But so when we look at this, the middle column there, these are the actuarial liabilities on the left-hand side there. And then on the right-hand side here is the what we could buy in terms of those securities that I talked about to potentially immunize that. So the par value is the amount that would mature, you know, in the given year, and each one of those you can see is enough to cover your liability that the actuarials are projecting on in the subtotal column under the light blue side. So that light blue header row is, again, that's kind of your actuarial information, and the dark blue headers are market information. Those are the securities that we would look at using as the assets in the portfolio. So the blue side, the light blue side is the liabilities, the dark blue side is the potential asset side. And so if you look at that first example in 2024, you know, you're projecting a liability cash flow of $5,612,906. So we could buy $5.65 million of a treasury security in that maturity for 0.9782 cents on the dollar, effectively, is what that means for a percentage of that par value. So the total to the right, it would only cost us $5.5 million to buy that today to cover that $5.6 million. Now that's only a couple months away, so we're not going to earn, you know, this year, we're not going to earn a whole lot of interest on that. But as you look further down the table and you go, let's go down to the bottom example, you know, in 2048, and this does continue on to the second page, but on 2048, you have, you know, 1.507 million in projected liabilities. We could buy a security with a par value. Again, this is a Treasury government security that would mature and pay us $1.55 million, so enough to cover that projected liability. And it would only cost us basically 33 cents on the dollar to buy that security. So we could buy that today for $510,000, and it would pay us $1.55 million in 2048 when we need it to meet that cash flow. And so that's the whole idea, that we've gone through each one of those years on your actuarial schedule and said, okay, well, what would it cost us to buy enough Treasury securities to go ahead and immunize that, right? To go ahead and lock that in. Let's get them. So now we have a maturity value that is there that we know that exceeds what our projected obligations are. And if we go one more page, Dawn, to the last page there, you know, this kind of continues it all the way out to the end of your liability schedule. Oh.
Sorry.
this kind of continues it all the way out to the end of your liability schedule, and that's why Mark said, when we actually did this analysis, we came back to, we think you're significantly overfunded. Because, if you do all of that and you discount all of those cash flows out using just the treasury securities we could go buy today, it would only cost us $75.1 million in securities. I say only, but it would cost us $71.5 million in securities to purchase to generate the $115.89 million that we will need over the next 48 years. To do that. And you already have 91 million in assets, and this was all as of the end of February. And it's only gotten more in your favor as the stock markets continue to go up a little bit. Interest rates have actually gone higher since we put this together, actually quite significantly. So it's gotten even more beneficial to you. But what we're basically seeing is that for $75 million and you have 91 million in assets, we could cover all 115 million in potential liabilities, and you still have $16 million in buffer, effectively.
Jeff Kirst, question. As I recall, our previous meetings over the years, we are trying to protect 7,500 people, plus the life insurance subsidy, is that correct?
I think those numbers are roughly correct. That's how many retired employees receive an OPEB benefit. The distinction here that we've been trying to make over the last several meetings, though, is there are hard cash outflows like these. We owe these qualifying eligible retired employees subsidies. Those are out-of-pocket payments, either right to the state PEB board or other entities. Then there are a set of liabilities that are actuarially calculated. And we talked about the implicit subsidy. Those aren't cash outflows. The actuary has to quantify the difference between what a retiree would pay for life insurance versus what they are paying for life insurance under our system. But that's not a cash outflow. I mean, they're not paying what they should pay, right? If you're 70 years old, you're paying what that blended rate per employee maybe at a 40-year-old life insurance policy would cost. And we have that cost covered because we charge a blended rate to our employees. So I'm not sure if I'm answering your question, but you mentioned life insurance. The OPEB trust reimburses the district's fund for the implied subsidy. It doesn't have to, because again, so there's a distinction there between a hard cost and not a hard cost. Yes.
As I understand it, the medical is legally required. There is a law somewhere that says OPEB has to protect those 7,500 people.
No, the legal responsibility to cover those subsidy payments is the district's.
And that's the medical.
Yes.
And last time when we talked, life insurance is not required. It's just something that is done. It's not even part of the union contract. It's just, they don't have to do that, as I recall.
I think that's right. So the collective bargaining agreements that were executed and agreed to do compel the district, do obligate the district to pay those medical subsidies for those eligible retired employees. It's the district's liability. To help fund that, the district formed an OPEB trust. Didn't have to, didn't even have to put away money, but the district's on the hook for those costs. This is a financially prudent mechanism to pre-fund those costs, put them in a different fund where they're safe, right? So they're in this irrevocable trust. No one can get to it. So it's right? So the district chose to do that. I'm just making a distinction. The OPEB trust is not liable. Ultimately, the district is liable.
Right.
For covering any shortfall in funding, right? And most agencies have a shortfall in funding. Most agencies are not anywhere near funding their OPEB liability. We are, but so maybe I'm, playing with, the fine meaning of language here, but I just wanted to make sure you understood, the district's on the hook
For the medical,
for the medical.
but not necessarily for the life insurance.
Correct.
And the funds that we are looking at are, we look at the tables and we know that nobody who has been an employee beyond the year 2006 is eligible for any of these funds.
That's, for us, that is correct.
For the
That's where
with the school district.
That's where the drawbridge drew for the school district, that's right.
And so if people retire at 60 with our tables here, we're not going to live that long. The people from, in 2006, if they retired at 60, they're not going to make it out to our, so we're really using this money to supplement the life insurance as near as I can tell.
No, these are what the actuary has projected for future medical and PEB payments, and it's based on mortality tables that actuaries use. I know it's way out there to 2072. We could bring in the actuary to answer that question, how could anyone possibly live that long? But no, on page 11 and 12, the heading is medical subsidies and PEB payments. That's all those numbers are. Those are the medical subsidies. Either they go to the state PEB board or they're paid via another mechanism. But these are not the life insurance subsidies. These
Right.
are the hard costs. Again, they came straight from the actuary. This is what he's projected. Obviously, by the time you get into 2060s, 2070s, right, there's just a few employees who are going to receive this benefit, he projects. But they are using, not to be, whatever, mortality, they're using actuarial mortality tables to derive that.
And they did that based on the actual lives?
Yes.
And of the birth dates, et cetera, of the 7,500 people who are,
Yes, we
Need this.
every year we give them the census data of who those eligible employees are with their birthdays and, other information. Every year we give the actuary that and they update that.
and that's our custodians, it's our support people, it's our teachers, it's everybody who is,
Yes, there were various bargaining units that received this benefit before we closed it off. Yes. And, remember, somebody can retire when they're 52. If you're a teacher and started in the profession when you were 22, you got your 30 years in, you could have retired when you were 52.
yes.
Yeah. So, any concluding remarks, Mr. Bowden?
No, the next one was questions and discussion.
Okay.
So,
A question,
yeah.
Jeff Kirst, question on the strips. The government does not issue the strip. Somebody breaks that up, is that correct?
Correct.
Who does that?
Huh? That is done by the, it's done by the exchange.
What exchange? Which exchange?
By DTC, who creates, yeah.
Okay.
But they're still backed by the full faith
They're
and
still
credit of
backed
the
by the full
United
faith
States
and credit,
government.
yes. The
Yeah.
government still is responsible for the underlying cash flow.
These are very similar to savings bonds, U.S. savings bonds. They don't provide you an annual coupon benefit, but they just have a deeply discounted maturity value. If you hold on to it 30 years or whatever, this is what, right, your grandma might have bought for you
Yep.
to go to college, right? Same principle, because that grandmother 15 cents, 20 cents on the dollar, if you hold it long enough, it has full cash value at the face amount of the savings bond. They're really similar instruments in that respect. There's no coupon payments and therefore no reinvestment risk.
If you take the money and you buy the strips as you propose in here, why wouldn't you just do a bond ladder and get the interest coming in?
You can, using strips is the easiest way to explain it, right? Because I can show you exactly what those discounts are. It is not, when we talk about it from a portfolio perspective, it is generally not the most efficient way to immunize the portfolio, but it's the simplest way to explain it and really present it. in terms of, you know, in the least efficient way possible, we still have a $16 million surplus. So there are you know, more efficient ways to do it, using coupons, laddering it, and getting all the, you know, you can reconstruct these cash flows in many different ways. You know, again, you know, looking at it from a strips perspective is, you know, generally the easiest way to just analyze, okay, where do I stand from a funding position?
It's the cleanest way.
It's the cleanest way.
There is no reinvestment risk. So when we buy bonds, there are coupon payments, and you have to assume the reinvestment rate on the coupon payments. Well, what happens if the market tanks, right? Then you're not going to achieve, say, 5% earned on the reinvestment of the coupon payments. You're only going to get 1.
Yep.
And so, you know, and people kind of don't realize that when they buy bonds, right? And so, you know, we all model that reinvestment of those coupons at the bond yield that we bought it at, but that's not going to be reality. So if we planned, you know, if we construct an investment plan, but it's based on a reinvestment rate for those coupon payments, that's not going to come to fruition. Either it'll be too low, you know, we'll either get more money or less money than those projections. Here, we know for a fact we're going to get that amount because there are no coupon payments to reinvest. We're just buying it at one point in time, holding it to maturity. We know what it costs at that one point in time to buy it, and we know the return and the dollar amount that we'll get back when it matures. So there's no guesswork in there. There's no assumptions in there. It's clean in that respect, in that you actually do know what you'll get right at the end of that term of that bond. You still won't know for sure the liability side, right? These are projected liabilities.
Yep.
So there's still going to be some unknowns, but at least it's just the cleanest way to portray it. And in some respects, the cleanest way to manage the portfolio. And it's, again, full faith and credit of the U.S. government. You're not buying corporate bonds. So it's also, from a credit perspective.
There's no credit risk.
Right.
It's nice and clean to explain it. And, you know, the one thing, you know, the idea of the laddered bonds, right, too, is you gotta think about your biggest liabilities are near term, right? So, because, you know, bonds do have coupons, right? So you can buy, you know, to your point, you could buy the 5-year bond and use those coupons along the way to meet your cash flow streams. But the problem is then you have a big cash flow maturity in 5 years, right? And your cash flow needs are declining over time, which is why it's easier and more efficient in a lot of cases to go through and kind of pair those off, as opposed to, you know, you can't buy a 10-year bond and you're not going to generate enough interim cash flows to meet all of the liabilities you have over the next 10 years just from the coupon income off of it. You have to have some of the maturity, you know, more maturity than income.
But the school district has to make up the difference because of the nature of the relationship with the 7,500 people who rely on this for medical payments.
Yes. Yes, always the district has to make up any shortfall. Now, given the fact that it only costs us $75.1 million to buy these securities, right? And we have $91 million, that's $16 million of buffer, right?
To cover, and that's where you're really in a great position, because you do have that 16 million that, you know, you can leave in the stock market if you want, that will provide some protection against inflation, right? You know, longer term, or you know, we can do a lot of different things with it to kind of give you some of that protection in case, you know, the healthcare costs end up being more than expected, right? You're in a significantly enviable position here.
How did we get up to 93 million? I think last meeting we had 83 million and we took 6 million out and gave it because the Board of Trustees had asked for that as the supplement.
We authorized that.
Yes.
These were the value of assets as of 12/31. I'm sorry, as of 2/29.
220.
So we've,
haven't reported on that yet in here.
I know, but it's in Business Plus, that was the value of assets as of 2/29. It's just been a run up in stocks, you know, which has been great, and it is great until it falls. And like I mentioned You know, I've managed some blended portfolios, and it's great while it lasts, and then you know, you lose 20, 30, 40%, and then you just kick yourself, and it's a brutal experience to say, I had 91 million, and then next year I have 70 million, and then the following year I have 60 million. It's not a fun conversation to have. And that's really why I felt obligated to raise this discussion. And, you know, as we work through the numbers, they're better than, I think, when we began this conversation. I mean, we're in a much better position. I guess the point is, why get greedy? If you can cover your liabilities with your current assets, is there a point to being greedy? We're not going to open back up OPEB and start giving people additional OPEB benefits. So, you know, I have the choice of de-risking and immunizing the portfolio, and feeling good about locking in historical run-up in the stock market and feeling comfortable. Or I can get greedy and worry about, you know, a bear market and losing 20% or more, and then starting all over again in terms of the district having to make contributions and so forth to get up to that point. That's really the crux of the question, is where do we want to be? Honestly, as I've looked at this many, many times, I'll just come out and say, I don't see a compelling reason why we wouldn't de-risk at this point.
Sure.
I think, you know, because you're just putting yourself out there for a risk. Now, I didn't think the stock market would get as high as it is, Mr. Kirst, right? Because I'm a pretty conservative guy. I never thought we would reach these levels. So it could still go up. But again, to what point, if you've already got enough money to cover your liabilities?
But the liabilities are still open-ended, so we could take a portion of it and
We could
just in case.
Yeah, I mean, we have enough excess assets, if you will. We could keep that with RBIF.
A little bit.
A little bit, 15 million, if that's a little bit. Probably for you, that's a little bit, you know. So,
Yes, that's true.
so we could keep 15 million in RBIF as a buffer, and
With our stock,
yeah, and have that blended stock fixed income portfolio, and then take the 75 million or whatever it turns out to be, and put it in fixed income and immunize the portfolio. So you can have, to some extent, I guess, the best of both worlds a little bit.
and our investment advisor, who you trust, can do all this.
He would, yes. Buckhead Capital is very well qualified to construct an investment portfolio, a fixed income investment portfolio. All they do is fixed income. And so they are very good at it. I got to say, this is a pretty simple portfolio concept. It wasn't a lot of brain damage. Matt suffered to do this. But yeah, the action that if this committee was amenable to it, you know, the action would be to authorize contracting with an external professional investment manager and to prepare an investment plan to be submitted to the Committee of Local Government Finance, you know, which is required in law.
Okay.
If we wanted to go down this road. And then you would leave that up to district staff to kind of execute those documents. I don't want to say this is just fuss no muss, we're done, you know, let's take a 10-year vacation. You know, that's not what's going to happen. When an OPEB trust utilizes its own investment approach, there are strings attached. There's an annual investment plan, there's annual training, there's some other things that are, you know, we're obligated to do then, and which is only prudent and reasonable. But yes, if this committee was comfortable with this direction, I would look for a motion, as is kind of displayed here in agenda item 2.04's wording, authorizing the district to contract with an external professional investment manager and to prepare an investment plan to be submitted to the LGCF. That would be the action.
Jeff Kirst, another question. You said your team had 3 people. They were at, I think I read it was Stable River, which is part of Sun Trust. What if your team decides to go someplace else?
Well, we have maintained continuity of that relationship for an extended period of time. But yes, we were at a big bank at SunTrust, and we left and went to a small boutique investment firm that is, it's effectively, it's our firm. So we're not, there's nowhere else for us to go other than from our own firm. And we're you know, we've, like I said, we worked together for 20 years. The 3 of us there, you know, one place, SunTrust, doesn't exist anymore. But SunTrust, following 08-09, wanted to exit like all banks, they needed to raise capital, and so they wanted to exit the asset management business, and they sold our business. And we left at that point and went and joined Buckhead Capital, and we are the fixed income team within Buckhead Capital, and it's our business, and we have nowhere else to go.
I mean, and just to be clear too, if Matt and his team decided, hey, it's been fun, we're retiring, these assets are separately custodied at a separate custody bank of ours, and they're in the district's name, or in this case, in OPEB's name. And so we hold the assets. Buckhead doesn't. Buckhead simply transacts. They're the ones reaching out to brokers to buy the securities. If they sold them, they again reach out to brokers to execute a sale. But these securities, these strips, would be held in the OPEB's name at a separate bank. So if Buckhead goes away, we have to procure the services of another asset manager, and we would do that. And that's just how it works.
As trustees, do we have to negotiate fees with you, or is that something that you would already have done?
We have already done it. We would seek to, if we chose to go with Buckhead, got to be careful here. If we chose to go with Buckhead, I need some negotiating leverage with them. So if we chose to use Buckhead, we would negotiate an amendment to an agreement, because this portfolio is a little different and somewhat more basic than the portfolios they manage for the district. So I would look for a lower fee. See, thank you for letting me negotiate here like that. But yeah, district staff would do that.
So what you would like is a motion for us to proceed along this line to immunize these funds,
I mean, I think you
to
can
explore it and get it.
I think you hear where kind of I'm at, but I'm not, you are trustees, and you get to make up your own minds, and you get to vote, by your own conscience, and kind of where you're at. So, but the agenda's been styled so to allow a motion like that if you're favorable to this concept.
And we're sure that for their medical payments, I checked to see what anticipated medical payments were, and if the actuary is incorrect about that, and the medical payments are much, much higher through the inflation or whatever happens, the insurance policy for these 7,500 people on the medical side is covered by the school district.
Yeah, but as we said, I mean, these are actuarial projections, and it could be the case that medical inflation's higher than what they assumed as part of their actuarial assumptions. And if you look at one of those actuarial reports we've given you, you can see there are assumptions in there. Certainly, those assumptions might not be realized, in which case the liability is higher than what they currently project, in which case we've got to cover that. Now, again, having 15 million of excess assets is a pretty good buffer, right? But if that was not adequate over time, yeah, the district would have to make that up.
Okay.
Mary Lamont, so what we're talking about doing is taking all of it but 15 million and putting it in these strips, correct?
That's right.
So is that?
Or a comparable
or-
fixed income
Okay,
investment.
so is that kind of the same thing of taking your son's college education, you got what you need, now you're putting it in something
And
else?
putting it in cash.
And that's what we're doing, we got what we need, we're putting it in. Okay, and then I had one other question, but it's out of my head. I'll think of it.
I have a question. The 15 million that Jeff brought up, do you think that's a good number, or do you think we should be less or more?
Well, I mean, most, to Mark's point, most trusts are not in that position that they have that kind of surplus. I mean, it's, you're really in a unique position here that your portfolio, that you have this funding status, you know, at this time with these interest rates where you have the ability to do this right now, right? And it's a function of, again, just the equity market run up and where interest rates have gone to. So, yeah, I mean, and you don't need more than the 75, you know, according to this analysis, more than the 75 million to lock up these costs. So, you know, the 15, 16 million, that comes from, on page 12 of our report, that bottom right box there, right, was the difference between your assets and what we think it would cost us to immunize that. There's that kind of $16 million excess reserve that's there. So, I mean, that's where that number comes from. I think it's plenty. Yeah, I mean, and in a far better position than others.
Jeff Kirst, the 15 million, it doesn't all have to be left. We could actually have a bigger surplus buying your strips, correct?
You could too, yes, you could do that.
And have a smaller portion than 15 million that is exposed to the stock market.
Yep.
And if we've made a mistake, let's say it's 10 million, and the market drops by 50%, then $5 million is gone. But then by the same token, if we have a lot of inflation and companies can raise prices and everything goes up and the stock market keeps going, we've got a little bit there just to protect for the future. We're not all stuck with the fixed income.
Yeah, I think that's why it makes sense, because I mean, in the short term, stocks don't do real well in an inflationary environment, but over the longer term, to your point, when companies can raise prices and pass those things on, you know, stocks are your best bet against inflation that you have. So, you know, that you know, is what that would be, you know, ideal for, to give you that extra protection.
And you, as an investment advisor, would be able to figure some of these things out for us for our next session? You would tell Chairman Mathers?
In terms of?
Well, you've illustrated the strips. We've got the surplus. If we decide we're going to say, well, we don't want 15 million, we want excess in the strips, and 10 million for exposure to the markets, you'll figure that out?
Yeah, we could present that to you for sure.
You're not just fixed income. You can figure out where that would go, right?
Oh,
Leave
no.
it with the state.
Well, I think what you're suggesting is actually a pretty good idea. I think, you know, maybe instead of 15 million with RBIF, it might be 10 million.
Yeah.
You know, we can model that with Buckhead.
Okay.
But for your equities exposure, it needs to be through RBIF.
Okay.
All we would contract with Buckhead for is the fixed income OPEB portfolio to immunize against liabilities. But I think what you're, you know, kind of hedging your bets a little bit, I think that does make sense.
And with RBIF, will they allow us to, right now, it's what, 49 domestic stocks, 20 foreign, and then the rest is bonds. Will they let us just be in there for the, no?
No, it's all or nothing. You're either in their blended portfolio, or we could also engage an asset manager or just put it in passive index funds to invest in the stock market. I don't want to go there quite yet. You know, that's kind of, you know, we're one step at a time. So you know, maybe it's leaving 10 million with RBIF, and it is in a blended portfolio, but so be it. But no, they won't let you take just a slice of the RBIF portfolio. You got to take the whole thing.
Okay.
Mary Lamont. So a couple years down the road, this all goes to heck in a handbasket. Are we?
Like, give me a scenario when you say the
Well,
heck in a heck
Well,
basket.
let's say, you know, the stock market goes up, the stock market goes down, we lose our money. Are we out of luck? I mean, could we change and go back to where we are?
Well, the great thing about de-risking and going with a portfolio like this, there is no risk like that. We're out of the
Okay.
stock market. 75 million of our money is out of the stock market. So you have no risk in terms of the stock market for that 75 million.
Okay.
And as long as you buy and hold those securities, there's no risk of losses. Now, the 10 to 15 million you might have with RBIF, that could go up or down with the stock market. But again, that's buffer. And maybe you're willing to ride out. So you've got this set and protected. And so that 10 to 15 million with RBIF, you're willing to let it ride, right, over time.
And say that really went up, could that be added?
Yeah, you could choose, yeah.
Or whatever it's in.
Sorry to cut you off. Yeah, at a later point, you can always choose to make further withdrawals out of RBIF and put it in this portfolio.
Okay.
Yep,
Okay.
yep.
Okay.
And, you know, you could choose to sell off this portfolio at some point. I'm not sure why you would. But, right, it's not like this isn't, you know, that isn't liquid, that you can't sell it if you chose to. But again, the point is to de-risk so that
Right, okay.
there's really no risk of not receiving that return as long as you buy and hold.
Okay, thank you.
Fran McGregor, just to clarify then, I think, you know, we're in a really good position that we're able to do this. And that 10, 15 million that we're talking about, we're not going to determine that today. That's going to be between you and the the management company.
I think it can be. Yeah, I think we can have, if you're giving us that discretion, I think that's fine.
Okay, thank you.
And since we have to keep it, that portion with RBIF, it's, almost 30% of it is in bonds anyway.
Yeah. Listen, I really appreciate the discussion. I asked Don to send around an email with a Wall Street Journal article from last week that talked about pension systems, you know, reducing their exposure to the equities market, kind of along the same lines. Hey, we've just seen this huge run up over time, and you know, what comes up must go down, that kind of a thing. I think I seem to think all of you grasp the unique position we're in. And this is, I don't want to say innovative, maybe that's too strong of a word, but I think this is what, as fiduciaries, you should be doing, is looking at your portfolio over time, periodically reviewing it, and kind of making these kind of determinations. And there may be one other agency that withdrew out of RBIF and perhaps is doing this, but I know of no others. And, you know, I mean, if this is the vote of the board, I'm likely going to share this with Washoe County, where I worked before, because we talked about this 10 years ago. Now they're in a different spot. They're not fully funded by a long stretch, but it's still, you know, a worthy conversation to have in terms of protecting your assets. You know,
The county also adds people to the pool constantly.
they do. It is an open system.
Where what we're talking about is closed.
That's right,
Which
and
is
that's why they're
also unique.
right. We are in different places, but it's open still. But you had to have been employed by the county prior to 1999, I think, might be 1997. So you don't have to have retired yet. But if you're like my wife, who was hired before 1999, and you get 20 years in, you get free medical care for the rest of your life. They cover 100% subsidy of that, which is a really great deal. But yeah, it's open in that sense, in that, right, there's no limit to that exposure, and yeah, there's more people that will go into the system. It's closed in the sense that you had to be working by 1999, so you know the upper limit of what you have. But anyhow, they're not nearly fully funded, but at some point maybe they will be. Any other questions or comments? It's like you all are pondering things very seriously. Well, I'm open to a motion. Okay.
Fran McGregor, okay, I'm going to try this. I move that we provide direction to school district staff to contract with an external professional investment manager to prepare an investment plan. Does that make sense?
Mm-hmm. Yes, very good.
Mary Lamont, I second that motion.
Okay, is there any public comment out there? I see our budget director out there, and he must be okay with this, or else he'd get public comment. All right, I've got a motion and a second. All those in favor say aye. Aye. Nays? Hearing none, the motion passes unanimously. I appreciate all the thought that has gone into this.
Thank you.
And now we turn to section 3 of the agenda, and this is where, if there is any public that would like to give public comment, they could also do so at this time. Okay,
I do have one more question. Did we just spend $75 million?
we did not spend.
Well, okay.
We,
Plan is being set up
to invest it in a different way. We're investing what we have. We're not spending, it's not going out the door. We're not spending, we're investing. All right, seeing no public comment, then item 3.02, just a notice, we'll see each other back August 22nd in the heat of the summer. In the meantime, we will start executing on the direction you've provided here today. We'll certainly have news along that front in August for you. And with that, I really appreciate everyone's, again, questions and deliberation, and we are adjourned.